An economic recession can have a devastating effect on individuals and businesses alike. It is therefore important to know how to protect your money when a recession hits. Whether you are saving for retirement, paying off debt, or investing in stocks, understanding the risks associated with a recession and taking proactive steps to mitigate them can help you safeguard your financial future. In this video, we will look at some of the key strategies you can use to protect your money during an economic downturn. Instead of panicking, focus on planning. Recession can be a scary and uncertain time for many people, especially when it comes to their finances. In times like these, it is important to have a plan in place so that you can protect your money and maintain your financial security. By planning more and panicking less, you can take the necessary steps to protect your assets during a recession. Some of the ways in which you can plan ahead and prepare for a potential recession are creating an emergency fund, budgeting carefully, diversifying investments, and taking out insurance. We will also look at how planning ahead can help reduce stress during this difficult period. Creating an emergency fund, this is one of the most important ways to prepare for a potential recession. It is important to have enough money saved up so that you can live comfortably while waiting for things to get better. If you don't have an emergency fund, then it is likely that your expenses will outweigh your income. You can build up the funds by saving and spending less than you earn each month, or by investing some of the money that you make so that it grows over time. Some people use their savings as a buffer during these uncertain times because they know when the economy rebounds and their investments start to appreciate, they'll be able to retire or pay for a new home. Some spend their savings on travel, a college fund for their kids, or funding current renovations. After creating an emergency fund, one of the best ways to protect your money is to budget carefully, diversify your investments, and take out insurance. By budgeting carefully, you can ensure that all of your income goes toward essential living expenses and not toward unnecessary purchases. Diversifying investments allows you to spread out risk, so if one investment does not perform well during a recession, another may still be able to provide some financial stability for you. Taking out insurance is also an important way of protecting yourself against any unexpected events during a recession that may cause financial hardship for you or your family. Why is it important for me to take out insurance? Insurance could help you protect your property, pay medical expenses, replace the income you might lose if you're dismissed from your job, or provide financial stability during a difficult time. Try and increase your cash reserves. During economic downturns, it's important to have a plan for your finances. One of the best ways to protect your money during a recession is by bulking up your cash reserves. Having some extra money on hand can help you weather any financial storms and make sure you don't run into trouble if there's an unexpected expense. We will discuss some of the best ways to bulk up your cash reserves so that you can be prepared for anything that may come your way. 1. Use credit cards to pay for everything you can. Some people need to use credit cards to purchase certain things, such as vacations or furniture. However, if you make a conscious effort to use your card to buy every single thing you can, then this will also help build up your cash reserves. In the event that there is an emergency and you need money quickly, having some in reserve will help you avoid taking out more loans or selling stocks just for quick cash. 2. Consolidate your debt. Pay off all of your high-interest rate loans and credit cards as soon as possible. This will help you avoid any extra interest that is charged if you take out a loan to pay off the balance on your current card. It's also important to make sure that at least one or two of these loans are paid in full so you don't incur any late fees or have the opportunity to get into more debt. 3. Buy long-term investments. Long-term investments can be a good way to build up some cash reserves during tough times, but they should be done with caution. We recommend that you avoid putting all your assets into long-term investments. We would recommend keeping a little bit in cash and then gradually moving it over to long-term investments. Build a second stream of income. During a recession, it is important to protect your money. Finding an additional source of income can be the best way to make sure that you are prepared for whatever comes next. Investing in a second income stream can help you build up a portfolio of assets and provide financial security in uncertain times. We will look at some of the ways you can seek out a second income stream and how it can act as a protective buffer during times of financial turmoil. We will also discuss which methods are more reliable and secure than others so that you can make an informed decision about how to protect your money during a recession. The first thing to consider when seeking out a second income stream is your overall financial security. Your ability to find another source of income depends on several things, including your current salary, the amount you have saved for retirement, and the amount you are comfortable with risking in order to find a new source of revenue. A good starting point for evaluating how much risk you can take is by looking at your current monthly expenses as a percentage of your total yearly income. If less than 25% of your annual income goes towards monthly expenses, then it may be possible to find other ways of earning money without significant risk or sacrifice on your end, if you are willing to put in the effort. If more than 50% of your yearly income goes towards monthly expenses, however, you may need to look into increasing your current income through different methods, e.g., negotiating a raise at work or finding a second job. It is also important to consider the risk of taking on another source of income. In evaluating the potential risk, consider how likely you would be to fall back on your original source of income if the new source fails to provide enough money for you and/or your family's needs. Do not act on impulsive investing moves. Investing during a recession can be tricky. Many investors are prone to making impulsive decisions during times of economic uncertainty, often resulting in losses. That's why it is important to resist the urge to make hasty decisions and instead protect your money by using a strategic approach to investing. Through careful planning and research, investors can efficiently use their money to generate returns even during difficult economic conditions. An investor's strategic approach to investing is based on three key factors. 1. Market research and valuation. This research involves identifying investment opportunities in the market that are likely to provide returns, despite the market conditions. It also entails developing a basic understanding of how much those investments are likely to cost today, based on their fundamental valuation. Additionally, it includes determining what the potential returns might be for each investment over the course of its projected lifespan. 2. Investment plans. This process requires identifying different goals for your portfolio and prioritizing them according to how important they are to you as an individual investor. These goals could be as simple as saving for retirement, or they could be more complex, including setting up a charitable foundation that you hope to make significant progress on in the future. 3. Investment implementation. This process includes determining how much of your portfolio is allocated to each of your different savings vehicles, and how often you will invest in order to maximize the efficiency and effectiveness of your plan. Lock interest rates now. During a recession, the best way to protect your money is to lock in the interest rates on your investments now. This will ensure that you can benefit from any increase in market value without having to worry about unexpected changes in interest rates. Locking interest rates also gives you more control over your finances during an economic downturn, making it easier to plan ahead and stay ahead of rising costs. One way to lock in a long-term fixed interest rate is through an investment certificate of deposit. These are longer-term investments that offer a fixed interest rate for either a specified period of time or until you choose to withdraw your funds. It's also important to take advantage of any bonuses or discounts on your current investments. For example, TD Bank offers a 5% cashback interest rate for the first 6 months of opening a checking account with them. By taking advantage of this offer, you can potentially grow your money by an additional $260 before taxes and fees. Protect your credit score. During a recession, it is important to be mindful of your finances and protect your credit score. Knowing the right steps to take can help you achieve financial stability and avoid risk. We'll discuss the ways to protect your money during a recession and ensure your credit score remains strong. During a recession, borrowers might struggle to get access to their credit. To ensure that you will get qualified for a loan in times of need, it is important to have a high credit score. Credit scores are determined by the amount of debt you have while also considering your payment history. If you have a consistent and high credit score, lenders might be more willing to loan to you at low rates. If a borrower has a low credit score and is struggling during a recession, it may be difficult to qualify for loans. As a result, borrowers are looking for other ways to obtain credit. The first step to protect your credit during a recession is to make sure you have sufficient reserves in case of an emergency. If you're concerned about whether or not you're set for the unexpected, it's important that your investments are diversified and invested in stable instruments such as bank deposits and government bonds. In addition, having enough liquidity can help you avoid risk by investing in low-risk alternatives which might become more profitable during times of uncertainty. Rethink buying a home. Buying a home is often seen as an investment, and it can be a great way to make sure that your money is safe during a recession. However, it is important to understand the risks involved in such an investment and consider other options that may be more appropriate for this time. You should explore the different types of mortgages available, their pros and cons, as well as other financial tools you can use to make sure you are making the right decision when it comes to buying or investing in real estate. As an example, the real estate market is currently experiencing a downturn in value. A home is worth less while you are there than it would be if you bought it during a period when the market is booming. This means that you may have to spend more money on repairs or renovations in order to stay in your home until the market has recovered than you would have if you had waited for it. While this can be difficult, it is important to remember that owning a home does not always mean an investment, and some homes are simply meant for living as opposed to long-term investments. In addition, it is not always possible to know whether or not the market will recover. People who own homes in the United States are more likely to be able to retire. This is because the value of their home will continue to increase in value, which will provide them with funds for retirement. The value of a home is also more stable than savings and other investments, as it provides an owner with a fixed return on their investment. Thank you for watching.